Before I start my opening speech, I would like to read Antonio Guterres, the Secretary-General of the United Nations, congratulatory message. Every year, the United Nations Secretary-General, from Mr. Ban Ki-moon to Mr. Antonio Guterres, sent us videotaped congratulatory remarks. However, this year, due to unusually strange international crisis, Mr. Guterres sent us the written message, which I read now. Message on the 20th anniversary of the International Finance Forum annual meeting, F20 Summit, Guangzhou, 27 October 23. I extend my heartfelt congratulations to the International Finance Forum on its 20th anniversary. As you mark this milestone, we must reflect on pressing challenges facing global finance. Developing countries and emerging economies are suffering from growing financial crisis that is preventing them from investing in sustainable development goals. At the recent SDG Summit, governments welcomed my call for a rescue plan for people and planet and SDG stimulus that would deliver $500 billion annually in the long term, affordable finance for developing countries. International financial institutions, governments, and private sector must work together to scale up development and climate finance, increase the capital base, and change business model of multilateral development banks. We must ensure effective debt relief mechanisms and channel emergency support towards those in hand. Looking ahead, we must reform a global financial architecture that is dysfunctional, outdated, and unjust. International finance institutions can only address today's complex challenges if their governance reflects today's world. This is essentially to prevent fragmentation, rebuild trust, and pave the way for other structural reforms, including strengthening the financial safety net and creating a fairer international tax system. I look forward to contributions of the International Finance Forum as we collectively work towards sustainable and equitable future for all. End of the message. I start my own speech. Excellencies, Honorable Governor Wang Wei-Hung, distinguished members of IFF, ladies and gentlemen, I am very pleased and honored to open the 20th anniversary conference of the International Finance Forum, IFF, in this magnificent building today. I would like to thank all of you for having taken time to attend this year's conference here in Nansha. At the groundbreaking ceremony of this building 4 years ago, on November 24, 2019, I gave an opening speech by saying, I quote, "The Great Bay Area development is one of the major comprehensive development plans of the world today. When it is done, the Great Bay Area will be the largest Bay Area in the world, and the International Finance Forum will be located right in the center of this Bay Area. Guangdong has long been China's gateway to the world, and it is where China's opening up started. Now the Great Bay Area will be China's center of the fourth industrial revolution and will become the hub of advanced technology and sophisticated logistics. In the middle of the Great Bay Area, we are going to build international financial island where all kinds of financial activities will be carried out. Many financial institutions, both Chinese and international, will take seats in this island, working to promote Great Bay Area as one of the best financial centers of the world. IFF will be a lead forum to closely cooperate with the International Financial Island to further promote the internationalization of China," unquote. On behalf of the entire family of the IFF, I sincerely thank all those who have made this magnificent building possible. Party and government officials in Guangdong Province, Guangzhou City, and Nansha District, as well as the construction companies and their workers who have worked tirelessly to have made this possible. Thank you very much for your. Ladies and gentlemen, since then, COVID-19 has changed the world, and the global economy has been greatly impacted. The global economy is now navigating the turbulent waters of post-pandemic recovery. A multi-dimensional view of this recovery reveals several characteristics that bear immediate attention. First, economic growth is slowing down. Central banks, particularly in advanced countries, have rapidly raised their policy rates in a bid to control inflation. This shift has inevitable repercussions for global growth. The IMF forecast stands at 3% for both 2023 and 2024. These figures are markedly below the 20-year pre-pandemic average of 3.3 to 4%. Particularly for China, this suggests an extended period of subdued external demand. Secondly, we observe a distinct dichotomy between the sectors. Service sectors are recovering or even booming in some countries, while manufacturing is lagging. For countries like China and Germany, with manufacturing-intensive economies, this divergence poses unique challenges. Conversely, more service-based economies like the United States seem to be faring better in this environment. Thirdly, the critical feature is the potential for long-term scarring effects, varying significantly across the countries. Many advanced economies have been agile in mobilizing resources to support their economic structures, thus regaining their pre-crisis GDP levels. The story is different for many emerging markets and low-income countries. Without the fiscal space to react similarly, these nations face the bleak prospect of not returning to their pre-crisis GDP levels, inflicting lasting economic damage. China constitutes an interesting case to study in this regard. It recovered rapidly from the initial shocks of the pandemic, returning to its pre-crisis level by early 2022. Nevertheless, challenges remain. There are palpable signs that growth momentum has not only slowed, but that the economy is also drifting downward from its projected trend. However, the last quarter shows a better performance than expected. According to the IMF, China is expected to experience secular decline in growth due to long-standing, stranding structural headwinds. Its medium-term growth forecast has been downgraded below 3.5%, a sharp drop from the previous estimate of around 4.5%. This implies that China's GDP may remain below its pre-crisis trend level over the medium term. Ladies and gentlemen, moving to the financial arena, the banking sector has rebounded from immediate concerns about its health, yet elevated interest rates and tightening monetary environment continue to present challenges. Major central banks are tightening monetary policy, warning that this stance is here to stay for the foreseeable future. Yet, markets appear astonishingly complacent about the path for inflation and terminal rates. This dissonance has led to paradoxically eased financial conditions over the last few months, despite incrementally higher policy rates. The turbulence we witnessed early this year in the United States and Swiss banking sectors has been ameliorated by decisive actions from the authorities. Yet, a high monetary environment continues to pose challenges, particularly to banks and non-bank financial intermediaries. We are seeing declining house prices in multiple countries, escalating the cost of mortgage financing and exposing vulnerable households to great risks. What we must confront is this: Higher or more persistent inflation could trigger a sharp repricing of financial assets. This in turn would exacerbate existing vulnerabilities, tightening global financial conditions, and potentially precipitating a crisis. At this juncture, therefore, China's robust growth and financial stability are very critical for the global community. Ladies and gentlemen, in the post-pandemic world, China's credit-reliant growth model is encouraging turbulent waters. Up until 2021, housing demand has been a critical factor in driving local government revenues and propping up land and house prices. This mechanism allowed local governments to drive investment by leveraging their financial vehicles and bailing out indebted state-owned enterprises when necessary. However, since last year, the winds have shifted. Household confidence in housing has dwindled, potentially setting the stage for a period of prolonged market adjustment, similar to what we have observed in many other advanced and emerging economies over the last 20 to 30 years. This could lead to adverse macro-financial feedback loops with declining collateral values and balance sheet deleveraging. It would also exacerbate credit risk, particularly in less developed countries, less developed regions with high levels of debt in China. However, the recent recalibration in policy focus by the Chinese government is a substantive response to these economic and financial challenges. In a strategic departure, the government has pivoted toward bolstering domestic demand for sustainable growth and containing financial risks. This involves a series of comprehensive actions, amplifying consumption and consumer confidence, stimulating housing demand, buttressing high-quality property developers, and providing much-needed impetus to high-tech private firms. Equally noteworthy is China's policy shift to further open up its services sector and offer expanded market access to both domestic and foreign enterprises, thus ensuring a level playing field. On the financial stability front, this year has seen profound change to regulatory architecture. For example, the new asset quality rules have been introduced to tighten recognition standards for non-performing exposures and to update regulations on restructured assets. Additionally, revamped capital rules are now in place, engineering to incentivize banks to exercise greater caution in their risk-taking behavior by imposing differentiated risk weights based on the underlying characteristics of exposures. These changes, among other things, serve as a plug for existing loopholes, compelling banks to hold more capital against risky exposures, such as mortgages backed by unfinished properties. Institutionally, China has also made sweeping changes to its financial regulatory regime to contain financial risks. The National Administration of Financial Regulation was established to replace the China Banking and Insurance Regulatory Commission and to observe certain functions from the People's Bank of China and the China Securities Regulatory Commission. Notably, there has been a recalibration of power from the provincial offices to central authorities. This was achieved by closing provincial financial policy offices and limiting functions and authority of local government regulatory agencies, hereby enhancing the integrity and effectiveness of financial supervision. These upgrades are pivotal in reducing the scope for regulatory arbitrage and in mitigating local interventionism, which has until now impeded the restructuring of weak local banks and the control of debt growth by local government financial vehicles. Ladies and gentlemen, the course of modern economic history, however, has shown us that even the most well-intended policy overhauls are fraught with challenges and unintended consequences. While China's recent regulatory shift aimed to contain financial vulnerabilities, the inherent challenges of the transition cannot be overlooked. For instance, enhanced central control over local government debt, although essential, runs the risk of causing fiscal tightening that can be sharper than intended. This would exacerbate the challenges facing smaller banks and property developers who are already grappling with stress in the property sector. Therefore, the harmonization policies across 11 government agencies are imperative to steer the ship through these choppy waters. Internationally, if we examine the recent turbulence in the United States and Swiss banking systems, it becomes clear that merely erecting robust regulatory framework is insufficient. Addressing the underlying structural vulnerabilities is the key. In the case of China, this would mean tackling drivers of rapid debt growth such as growth target, narrow local tax base, and undue reliance on land-scale revenues. Regulators should continue to strengthen supervision and risk monitoring to better prepare for unforeseen episodes of banking sector stress. The comprehensive effort must extend beyond the banking sector to include non-bank financial intermediaries, a space that is less understood but equally vulnerable to liquidity mismatches. Another less discussed yet crucial area is the institutional architecture for crisis management. The emerging challenges that financial systems face today provide an unprecedented opportunity to revisit and reform this architecture. Our toolkit for crisis management needs upgrading. It is not just about having a plan, but an effective, dynamic plan buttressed by legal and operational arrangement for loss allocation and resolution funding to effectively respond when any financial institution comes under stress. Furthermore, authorities should employ macroprudential measures preemptive to caution against emerging risks. In times of market strain, liquidity support must be both prompt and forceful to limit contagion, all while balancing the ever-present risk of moral hazard. Ladies and gentlemen, at this critical time, confronting the era of unprecedented economic and financial challenges, we at the IFF must not only help adapt, but proactively shape our own regulatory architecture and policy toolkits. Whether it is a recalibration of growth models or necessary revamps in financial stability frameworks, both domestically in China and worldwide nationally, the key lies in the preemptive, comprehensive action. On this auspicious occasion of the 20th anniversary of its founding and at the world's best financial convention hall, we at the IFF should do our best to steer the ship through uncharted water with collective resolve, openness, reform, and careful coordination to navigate towards more stable and sustainable global financial horizon. This is the responsibility that is imposed upon us at the IFF and the leadership that is expected of at the IFF. Thank you for your attention.